So it's my pleasure to have as part of our panelists, to my immediate left, to your right, is Andy FOSKEY. He's managing partner with Transitional Capital Partners. Next to him is Eric Heath, Senior Vice President of the Tenney Group. And then to his left is Aaron MURSKI, Certified Value Analyst, Managing Director of Research for VMG Health. And if you all have heard of VMG, they're gurus in the healthcare space. So let's just kind of jump into this. What's very interesting about this panel is our discussion is going to be about how almost practically every company has applications and data at the PC level, and they're now trying to figure out, with all that research, data, knowledge, how do they convert their current technology platforms to maybe more of a SaaS-like model where, of course, they're looking to achieve SaaS-type valuations. So it was our great fortune to contact Andy, and Andy agreed to be on the panel. Andy has actually sold 3 SaaS companies, and he's got a portfolio company within Transition Capital Partners where they're trying to figure out how to monetize another company that could very well achieve SaaS-like multiples. Eric purchased a company and is in the throes of trying to find the right CEO software person to lead the company to make that transformation to, data that's on a PC. That's a great piece of software. How do you get that up into the cloud and monetize it? And likewise, Aaron and his firm, they have all this healthcare data that everyone would want, and they're working on projects right now where they are trying to monetize and convert that data from more of a PC level to a SaaS type. Are there any comments just with that introduction, and then we'll move on?
No, I think you got it, Brian. Yeah.
Okay. So just to kind of refresh everyone's memories, a SaaS company is an organization that utilizes software to host an application where their customers can have access to it. Customers can usually access that data that's on the web through practically almost any type of browser. And they subscribe to that by paying a monthly or annual fee. And that fee usually is determined by, how much data how much space they need, technical assistance, and the number of users. And what really comes to mind in today's world is, what's one of the largest SaaS out there? Well, it's typically Salesforce. That comes to mind. That's more B2B. I'm thinking that, my QuickBooks used to be just a PC application. Now it's all up on the cloud where accountants can get to it, I can get to it. A SaaS-like company, if you think about it, where it's business to consumer, maybe like a Netflix, or maybe even like a Spotify. So it's interesting technology. And again, today what we're going to try to do is bridge that gap as, how do you value non-traditional SaaS companies, and then those companies that really start looking like SaaS companies because they're changing their platforms. And with that, let's first start off panel by discussing what are the typical value metrics and differences between regular type, we're just going to use regular type companies, and then maybe more SaaS-like companies. Andy, you want to go first?
Sure. I think the easiest differential is, in its simplest form, SaaS companies are often valued on a multiple of revenue, where traditional old economy, EBITDA-based companies, I use all those terms, are valued on a basis of EBITDA. So, the reason why we're having this discussion, and we are today in one of our portfolio companies, we developed our own software to run our business. It's a fairly niche, unique industry, and we're now talking about productizing and monetizing that. And the reasons are the valuation difference that we're talking about. I've sold businesses for higher revenue multiples than I've sold businesses for EBITDA multiples because they were SaaS companies versus more traditional EBITDA-based businesses. And so the differences in valuation can be just massive.
Eric, any follow-up thoughts on that?
Yeah, I think it's, what's interesting is we do primarily sell-side advisory within the transportation space. So a lot of our clients will build software solutions around a problem that they've uniquely solved, and so then what they'll come to me and say, hey, I have this opportunity to go transform the industry with this software that everyone needs. Everyone needs it. If my competitors had it, they would take over the market. But they are not a SaaS company by tradition or by practice. So, but they have a really great product. So I think the hard part for us as a sales advisory is how do you give them credit for something that they've done that's a unique differentiator, but they're not up the learning curve yet of what it's like to build and scale a SaaS company. So I think it's hard to imagine paying 10 times revenue for something that has zero EBITDA, but it's real and it's true. And I think we saw even with the recent pullback, I think the tech companies on average were trading at let's say 15 times revenue. Now we're down to 9, but most of my transportation companies would flip if they could get 1 times revenue.
You're right. You're right.
Yeah. So I mean, I think that. So obviously the carrot is there, the apple is there, and so everyone is trying to figure out, well, how do I get up the curve to get there? And I think that I think there is a path, but maybe not as straightforward as just building the product itself.
Aaron, do you want to add some other comments to that?
Yeah, I think that's right. So my background's all healthcare services, which is, by today's standards, old school. It's EBITDA, it's growth, it's fundamentals. And healthcare, probably like transportation logistics, is just a bunch of disparate systems and then a bunch of really valuable data, right? So think about a healthcare enterprise that they're sitting on massive amounts of information, whether that be clinical data or data related to payers, everything. But that's not part of the core business model. And so, and what you see is pretty steady multiples, relative to other industries in healthcare. And it's been a problem that is in different, you've got different organizations and different sort of phases of solving it. But it's not straightforward. You almost have to stand up. There's a lot of cost, a lot of finding the right people to be able to grab a hold of that. It's not just something you put in your deck. Oh, we have this great in-house piece of whatever software thing. Well, how much is it going to cost, and what kind of team do you need to put together to actually get that valuation? Because until you do, it sounds great as a bullet point in the pitch, but I don't know that you attach a 10 to it, of revenue, right? It's still this old world sort of EBITDA focus,
And coming back around to multiples, in regular traditional companies, we might also use price to sell as discretionary cash flow. That's a metric that we use a lot of times in the valuation world that we're in. But on private companies, the typical regular companies, who's pricing many businesses on price to revenue? You just don't hardly do that. Maybe with paging, telephone answering, those back in the old days were priced like that. I think everybody learned that it's cash flow, which drives the business. But again, just to go over the numbers that Andy was mentioning, to think that, okay, we were at a 15 times enterprise value or price to revenue down to like 9. And according to Software Equity Group, their current or first quarter median number is 7.7 times EBITDA. Now, that's interesting. Graham's presentation yesterday for GF Data, I think his median was 7.3. I don't know how many tech companies are in that number. And what you see is, depending on the source of the information, these multiples are going to change. I went and pulled from Business Valuation Resources deal stats. Their tagline was, still trending positive, but the deal stats highest median price to EBITDA was 3Q of 18 at 5.5. We're now at 4.5 times. And again, BVR, or Business Valuation Resource, they handle smaller businesses, but that was 4.5 across all industries. In the information sector, though, trailing 12 months is 15.4. So the information sector, which would include some SaaS, has just been on fire. price to sales median at the end of first quarter was only 0.64. So you can see this huge discrepancy between just regular businesses, which are typically not priced based upon price to revenue, but you've got this new animal out there, a SaaS, that is commanding such huge multiples of price to revenue. By the way, the lowest price to EBITDA multiples, you can guess, accommodation and food service at 2.6. Interesting enough, education has been on a tear. The last trailing 12 months, EBITDA was at nine times. Another interesting fact, and we're going to dovetail into this a little bit, EBITDA margins in 2020 were on the rise to the highest level, according to BVR, since 2017. EBITDA margins hit 17% at the end of Q1 2022. The lowest was back around fourth quarter of 2019, where it was 9%. So again, I think you've got to be careful which source you use, but clearly these SaaS-like companies are achieving huge multiples of enterprise value to revenue, price to revenue. And Andy, I think you were going to talk about maybe a little bit more about software revenue multiples, or should we go on to the next topic?
Well, one thing I'd like to say is I've sold 3 software businesses that I own to strategics, and so I've got a reasonable, I think, window into how they value businesses, and I just want to address the price, sort of valuation on a revenue basis versus valuation on an EBITDA basis, because it's easy really for all of us that aren't in the seat of actually buying a business and figuring out where the return's going to come from and where the value is going to be created and what the equity returns can be out of an investment. It's easy just to throw around these multiples, and when we throw around EBITDA multiples, at least there's a driver of value, which is cash flow. We all know, revenue is really, in terms of an ultimate long-run driver of value, is only a means to an end to get to a margin and cash flow. And even though we're talking about all these revenue multiples, the buyers still, it's not a new world. It's a new world in terms of how public markets are valuing some of these tech companies, but ultimately driving returns to shareholders, the same exact fundamentals apply. And so when we were selling these businesses, we were really spending a lot of time with buyers trying to understand how they were valuing it, why they were valuing it, and what economics they were using. And so while it's just in many ways simpler to say, hey, here's a price to revenue, because that's easy and we can all throw around a bunch of numbers, the buyers were absolutely looking at EBITDA. And so we were triangulating, all right, what valuation are they giving us on a revenue multiple? What valuation are they giving us on an EBITDA multiple? And what they were all doing was looking at our EBITDA. Well, we'll get into this, but spending a lot of time on the quality of the revenue stream, and that's a super important factor, and we'll talk about that in more detail. But just in terms of valuation, really what they were doing was getting to a pro forma EBITDA multiple for them. And that's how the strategics were thinking about their business. They were not, one was public and 2 of them were private, but planning on going public. And they were all EBITDA multiple focused. Now they're high multiples, they were thinking they were at a 25 multiple, and they were trying to buy us, for a 15 to 20 multiple, and thus they got their 25% or so arbitrage. But the benefit to us, and these were smaller SaaS companies, by the way, our strategy, and still is to buy a SaaS company with revenue of $5 to $15 million in ARR, or annual recurring revenue. So it's still a smaller business, and again, I'll talk more about why we would, in any other sector, probably never look at a $5 or $10 million revenue business, but here we can talk about that. but that's what they were looking at. And the beauty of a SaaS business, you've got to book a contractual revenue. You know, you need to be very high retention on that, and you need to have really good gross margins. And good gross margins in a SaaS business are going to be 80% plus. You know, you're shooting for 90% true gross margins. And so when you think about a strategic acquirer buying a smaller software company that they can absolutely fold into their infrastructure, the synergies are massive. And, you know, it plays out in all of these strategic software transactions. A year later, you know, half of the employees are often gone.
You know, Andy, you mentioned in drilling down into some of the metrics. All right, so you mentioned a very important metric, gross profit, 80 to 90%. How about net revenue retention, Eric? Or Aaron, do you have a number as far as what a good SaaS company might generate? I've heard 90% net revenue retention is really kind of what we're looking for.
Well, as high as you can calculate it to be would be ideal. But yeah, no, 90+% would be great. It's sort of, that goes into Andy's point about the quality of revenue. And I think about a services business in our diligence practice, looking at quality of earnings, quality of revenue. It's fairly straightforward compared to a tech company quality of revenue, because you're not just looking at sort of these old world sort of drivers, cash rec, stuff like that. You're actually looking at consumer behavior to try to understand and predict how that's going to hold up. And so, because if you've got retention and churn that are going to change because of a competitive dynamic in the future, whatever it might be, you can take that thesis can kind of blow up in your face pretty quick. So it's a different, that quality of revenue issue is incredibly important. Again, if you're a services business trying to move to be tech-enabled or trying to create a data product or whatever it might be, that's a completely foreign thought, foreign exercise. It's just a different vocabulary. And once again, trying to capture that, and you know, if you're a founder-led business with no background in technology, it's going to be real hard to move into that space in connection with a transaction if you're not working on this, you know, years in advance.
And speaking of profitability, so in the SaaS world, there is a rule of 40. Well, if you remember from Graham's discussion yesterday, they rate high-quality companies on what I kind of would interpret the rule of 20. If top-line growth is 10% and EBITDA margin's 10%, or if those combinations equal 20 or above, that's a high-quality company. Well, in the SaaS world, there's a rule of 40, and they're looking at growth in revenue and the EBITDA margin. And if that's greater than 40, you've got a great company. You've got a good company. But there's that trade-off between you may have zero profitability and have the next new unicorn that's just growing dynamically. So there's that seesaw, you know, that balance. So in the SaaS world, it seems like it doesn't matter many times. And I think, Andy, you had companies that really were not that profitable, right? But yet they had great growth.
Yeah, when we bought them, and then we always strive to improve the profitability, of course. And that's the discussion we often have. Okay, rule of 40, like, we get it. You gotta, you know, you want to be as close to 40 or above 40 as you can. Where the nuance comes in and the discussion comes in among, you know, investment committees and boards is, what's better? Is it 40 growth and 0 EBITDA, or 40 EBITDA and 0 growth? And the market in times of more exuberance loves the growth side more. In times that it looks like we're heading into now, they love the EBITDA side more. And in fact, you know, we were referencing the public stats where in 21, the publics, now these are big companies, but we're trading at 15x revenue, and they've come down to 9, and it looks like they're trending down still. We're beginning to see that bifurcation of the companies generating profitability and cash flow are trading and holding up much better than the companies that aren't. And it's just this cyclic factor that you've got of, depending on how optimistic the market is about the future, which they value more.
You know, another metric that is highly looked at in the SaaS world is customer acquisition costs. What's your sales and marketing costs to add one new client? And so if your costs are less than 10%, that's great. But unfortunately, with a lot of these companies, they don't really keep good track of their customer acquisition costs, and they're really high. And if you see a high churn rate, you're going to have high customer acquisition costs. Another metric that's used is trying to figure out, well, what's the lifetime value of that customer? And there's a ratio of LTV, lifetime value, divided by cost of acquisition. If that's greater than 3x, you're tending to have a great company because there's retention, there's stickiness. Again, if your marketing costs are very low, if you're spending less, value goes up. That's the way that seesaw works.
Yeah, Brian, as
Go ahead.
you're reading your notes there, so I think that, again, as I'm kind of translating all of this kind of back to, everything that we're talking about right now is not very product specific, right? It's, we're talking about, commercial feasibility metrics, right? Like how has the market responded to your product, and how are they retaining? What are they willing to pay? What does it take to maintain that over time? So all of those characteristics are fairly non-existent in a non-traditional SaaS company that has built a product in-house, right? Like they don't typically have outside customers, so there's not a retention metric, right? There's not going to be likely 90% gross margin, and there's not going to be, the growth is probably just scaled to the size of their business, right? So I think it's kind of translating these things. If I'm a manufacturer or a healthcare services company, or I'm someone who's spent 7 figures or more building a product that I want to go then get a return on in the market, it's, well, what are the things that have to be true for the market to recognize the return? So just kind of bring that back to that space. It's not that the product doesn't have its own inherent value, but maybe not much more than the cost of putting it together.
Yeah. So I think that's a good segue, and so to really, to me, in its most basic form, why do SaaS companies get these huge multiples, and how does a company who developed internal technology, who thinks that could be valuable to their competitors or the rest of the market or even other verticals, how do you get there? To me, the answer is the vast value of a SaaS company is they've got a full diversified book of contractual revenue. They've got no material customer concentration. They've got very high retention at 90% plus. They've got great gross margins on that. And then however they decided to turn the dials on expenses is sort of board dependent. But that's where the value is, because as a buyer, as an owner, what I love about these SaaS businesses is the revenue is so predictable that as an owner, you can turn the dials on expenses. Do you want to grow? Go ahead and put resources in sales and dev, in administration to grow the business. If I want to lose money, I can lose money. Do I need to make some money? Go ahead and pull back on the expenses, because you know that the revenue is going to be there. And even if you under-resource, because you've got 1 to 3 year contracts, you can, if you need to, under-resource for a while to generate some profitability before your churn starts to rise and you start to lose some customers. And so you just have this unprecedented ability as an owner to make decisions on the direction of your business. Do you want to go super aggressive after growth? Do you want to go super aggressive after profitability? Do you want to go somewhere in between? Do you want to generate some cash flow because you see another opportunity, or you want to develop a complementary product? Like, you've just got so many options. And that is why there's a whole bunch of other metrics we can look at, but that is why these things are so valuable to me. And so just to sort of segue to the discussion around how does an owner that develops technology internally sort of get to that point? Well, the answer is it's a long road, because you need a diversified book of customers. Let's just start there.
And can I add?
Yeah.
We do some fair value valuation work, purchase price allocation. When we get to our favorite topic, customer relationships, well, that's attrition analysis. That's your churn rate. And a lot of these small companies do not have the data. I mean, the owners don't really know, well, how long has this customer been with you over the last 5 years and how much money have they spent? So a lot of the internal reporting resources are just, haven't even been thought of or not even there. Aaron, did you have some other comments on that?
Well, yeah, it's really that that transition that we're kind of talking about. If you've got a $5 million EBITDA company and you need to hire, and you've got some in-house kind of bootstrapped product, and you're using it, you kind of go, okay, product market fit, product. It's not built to scale. It's not. If it was developed over a period of time, it's definitely not using. You're definitely not using the latest and greatest sort of solutions in your stack, in your infrastructure. So it's really getting people to think about it in terms of it's just a startup, right? Which when you got a $20 million EBITDA company and you need to hire a couple developers, much more palatable. When you're a $5 million EBITDA company, not palatable, right? And so there's just sort of margin for error that scale provides that sort of allows a company to start transitioning to services, to tech-enabled services, to actually spinning out a data product. But it's sort of the success comes that I've seen working with large health systems, large institutions, is really standing up that mousetrap of you convert from sort of a services, tech-enabled services, and then you actually have a team that's got a VC mindset, right? It's a completely different, and it's a VC mindset, and you're thinking about where are we, pre-seed, seed, Series A? Do we have the management team? What do we have? What do we need to sort of build value? And it's a completely different mindset than sort of what got you there.
And as a result, it's hard to hire the top talent for that. I can tell you, building a real internal tech team in just a normal old company is very difficult.
So as Eric mentioned, this is something that we're all going to face as deal advisors. With the technology market evolving to the cloud, more companies than ever undergoing technology transformation. The trend has now trickled down to the middle market, lower middle market. Most companies are trying to choose some type of technology. They're maybe trying to choose some off-the-shelf type of products, which I'm not sure they even work very well, but they're also forcing to take a hard look at, can they develop the internal technology to be more like a SaaS? And I think, Eric, with your trucking company background and some of the technology, you had some comments on, how there's just disparate technologies all over the place that you're trying to link, right?
Absolutely, yeah, and I know Aaron has the same in healthcare, so there'll be 8 or 9 different technology solutions that a trucking company have that the systems just will not talk to each other. Billing won't talk to routing, which won't talk to payroll, which won't talk to something else in accounting. I mean, it's just nothing will talk to each other. So getting something that can just move data sets and translate data, because likely that data those software they were programmed or coded at some point over a 30-year span, and maybe one was built 30 years ago and one was built 1 year ago.
Right.
And so they're just not, they weren't built in the same millennia. so they need something to translate and move the data sets. Absolutely. And it was interesting, not to kind of revert back a little bit, but we had this conversation at dinner last night. We were talking about what it's like to kind of put that leader in place and really thinking about this in terms of someone who's sitting at the intersection of product and sales, right? And that can move forward with all these metrics in mind, and how do you navigate those? And I thought it was fascinating. I know Aaron's doing that, or working on that with BMG. Andy, you've had to do that. So both of you have way more experience than I do, but just in terms of, it's one thing, if the only challenge was to build a product, that would be really easy, right? If it was just, let's go build a product and be coding, that's just a money problem. But if it's build a product, manage a sales team, and then manage their competing ideologies going forward, is in terms of features and opinions, and very strong, well thought out, very intelligent opinions going forward. So anyways, just pointing back to that if you're a services company in any other space, then you might not, most likely not have someone who can sit in that seat of in between product and sales and do it successfully.
So this kind of leads into the next section. So what are the business considerations in productizing internal tech? I mean, what do owners need to be thinking about, looking out for?
Cash flow first. It takes a lot of money to build an internal system successfully, especially one that's not native to other architecture that would essentially, render your product not saleable to anybody else. We're dealing with a little bit of that right now. We've got in one of our companies where we built our own internal system, which we think is great, but we're on NetSuite architecture in a piece of it. And as we're talking about really commercializing that and selling that to some of our friendly competitors, essentially, it's providing complications both with our license, first and foremost, and we're really looking at that and saying, we've got to be off of NetSuite if we're really going to be able to commercialize this. And so you've got to go through your whole architecture and relook at it in the mind of, okay, I'm a SaaS software company. I've got to build something completely myself that's mine, that I own the IP, that I can now go license essentially. So that takes a lot of money. I would put that first and foremost.
How about a distraction from the core business?
Yeah, it's hugely distracting, and it's a different, it's sort of a different problem set. And I think, Andy, this was kind of one of your observations yesterday, was it comes down to the people. It's like you want a SaaS multiple, you want a tech multiple, not a services business multiple, multiple over flexibility to scale. Well, you got to have the right people, and as investors, you got to have the right people in place that can make high quality decisions to help prioritize, navigate sales, navigate DevOps, and get something to market in an efficient way that's reflective of the right choices that avoids some of those pitfalls that even experienced companies run into.
And totally different than the skill set that your CEO of that business has now. This is a completely different skill set. Maybe he's super dynamic, or she's super dynamic and able to manage both of those, but it's unlikely. And so how do you set up the management of that separate business? Do you need to separate it from a legal entity structure? You're going to eventually. How do you do that? Intercompany valuation considerations. How do you set up those boards? How do you fund it? Just lots of stuff.
And then it's the caliber of talent. It's the caliber and the quality and the background that when you're a sleepy services business with an opportunity, like without a really probably massive sort of incentive equity package to go along with it, how do you really incent the right talent to leave what it feels maybe a little sexier, a little bit more current, a little bit more modern environment of an actual tech company to kind of jump ship and take a risk on, a 3 to 5 year period of a career to help some high risk, what they might view to be some high risk, period of time for them, to actually go kind of build, deal with the personalities and the politics of a new organization that has, no experience bringing something to market.
Small company corporate tech attracts a completely different type of individual than startup early stage software company with a cool name and a cool vision. Just completely different, and potentially equity incentives, and everything's different. We really struggled with that internally with our company of trying to build an internal tech team, in a sub $100 million revenue business. It's very challenging.
So the ability to kind of get that SaaS multiple, or even move in that direction, it sounds good. I know we're our company, we're on our second recap. We've got a sponsor, Northlane Capital, and as an owner, as an investor, you go, well, that's our multiple, but I like that one. It's higher. How do we get there? And it's something I think everybody's thinking about and everybody sees, but it really is is that something for sort of this investment cycle? Yeah. How much progress are we really going to make in this investment cycle? We're going to keep doing what we're doing, but it doesn't happen overnight. it's a long road.
And so you start with, okay, the board makes a decision, you got to develop internal tech, right, which is a huge decision. So you got there, and you probably got there because there was no commercially available system that really suited your needs, right? So you make that decision. That's a huge decision. And now, you're in for a several-year project, and, geez, I hope you meet budget. We've never done that, but
Andy, do you go all in? Do you spin it out? Do you make the commitment to invest and grow? I mean, those are going to be the decisions.
Well, so this is the first step, and if you get there and then you develop it successfully, you got to get that done first, because if you can't get your own company right, you're not going to get anybody else's right. So you do that, but you could do that with a vision for ultimately this goal, this objective, maybe this dream, and make decisions along the way in view of that, such as I'm not going to use a big chunk of somebody else's architecture, right? I'm going to develop more internal resources. And so you do that along the way, and then when you get your own tech right, then you sit back and you say, all right, is this really commercially viable? Let's just start there. Can I sell this? Do I want to sell it to my competitors? What if this is, that's something I worry about this company we've got now. We've spent 5 years working on this, saying, man, this is going to be the hugest competitive advantage, and we're going to take so much market share when we have this technology nobody else does, and this industry is so antiquated from a technology perspective, and man, we're just going to game change this whole thing. So we spent 5 years with that mindset. Now management says, and the board says, hey, maybe let's go sell it to our competitors. I'm sitting back saying, doesn't that just defeat the purpose of what we were talking about, of our true competitive advantage? So you're thinking about those sorts of things. Can you really scale it? Can you resource it? Can you sell it? And because meanwhile, in all the time you've been working on this, I promise you, other competitors have been working on the same thing, and really assessing the landscape and the competitive set, and not just what's in the market, but what's coming to market with competitors and software companies that have way more resources than you do, and trying to figure that out is all has to go into the mix.
So what do you think? I mean, you mentioned 5 years. Y'all been thinking about it and working on it. Eric and Aaron, what do you think the typical time frame, realistically, if you were advising upper management, you can't have some software guy come in and say, gee, we can knock this out in about a year. What do you think the cost would be and time frame?
Well, so depending on what you're trying to build,
right?
There's in my world, there's some product opportunities where if you find the right outside vendor, sort of technology partner, and you've got a little bit of internal resources that can help manage tier 1 issues internally, you can do a lot concisely. But it comes sort of the solution, and the best way to come up with the solution and what the actual problem is, and what that means for use case, and what that means for features, and what you need to build. You get that wrong, the solution's going to be wrong. And so the right technology partner, you don't have the internal capacity. Finding the right technology partner is probably the key. Once again, it's sort of the same thing as having high quality management. It's aligning with the right folks that have built what you need built before, on time and at budget. And you can do it in a year. There's, is it some game-changing enterprise-level solution for somebody? Probably not. But if we've got a customer base that needs this solution, we understand the problem well enough because we live it every day, you can achieve a lot with, the current solutions that are out there at a reasonable. It's not cheap, but you can definitely do it.
Aaron, I think that's a great point. If I had to do it all over again with this one particular company, that's what I should have done. I should have hired, now it's going to be my IP, you're working for me, but you guys know how to do this, you've got the team, you can attract the best people, I can't. Should have done it. Yeah, that's a great point.
And some of the timing there, if we're talking about what is it going to take to go, and if you're trying to expand your customer base, it depends on how sticky those other products that are available are. They may not be, your product may be exponentially better. right? But if your customer base are Fortune 500 companies that run, and it's the lifeblood of their business is to run on the software, there's no telling how long it'll take them to switch enterprise solutions. So I think that's one of those things. I mean, even for us, like a small little investment bank, switching CRMs took a couple years. So that's it's one of those things.
I have a question. So, what have you seen when you're talking about a company, for example, like a logistic or a trucking company that has developed their own technology? As it's growing, how does the management of the original company maybe incentivized on bonuses that are now that money is being funneled over here? What's that like? I mean, has it been an issue? Have you seen anything where that's a situation where maybe the original management's not really happy that there's all this cash going somewhere else?
Yeah, that's a great question. So what I've seen in a couple companies is, yeah, they've had to, some of the top level managers, I think have gotten phantom equity partnership, kind of like, hey, when we sell, this will be the tide that will raise all ships. So it's not as much of an immediate compensation model as it is maybe kind of a downstream effect, because there's no real cash flow for several years, right, to go and then compensate all the other managers at a higher level. And it does take a lot more money to, especially in the transportation world, to hire a developer than it is a dispatch manager, right? And incentivize them and keep them going. But the dispatch manager is probably creating a lot more money for you than your developer is, right? So I think that, that's not even at the upper management level. So I think that what I've seen, kind of going back to Brian's question before, is you almost have to silo those operations and those companies, because the comp is tricky, the incentive plans are tricky, the way that they like to be managed. Developers are not like the rest of us, right? They think differently, they operate differently. So I mean, you just can't put it into the same model and you have we do a 3% comp correction every 6 months, and that should get us. I mean, it's just not going to happen.
In Lindsay, in our company, we all said the day we decided to embark on this technology journey.
It is a journey.
Yeah. We all said, okay, every board, management, everybody agree with this. Yep. Okay. What's the budget for it? All right. We're all equity owners in this room. We're all, investing in this, and we all are going into it together. And we all are making some sacrifices, and so you got to work all the numbers. And what we liked about that was management said, yep, we got to do this, guys. This is going to be a real competitive differentiator. We need to do this. We're going to change the industry, so we want to invest into it, essentially. And so that was a good dynamic.
Have you managed to stay to budget?
No.
Yes.
Can you discuss the components and the difference between the quality of revenue and the quality of earnings? And what's the most significant, or are they equal?
Yeah, and the quality of revenue and earnings in a SaaS company versus a traditional company?
Yeah, you talked about
Yeah.
quality.
Yeah, sure. Yeah, I'll kick that off. So when we're looking at a SaaS business, we're spending a lot of time with the quality of revenue, starting there, of course. And so we're literally going to go through every contract. We're going to look at the contract terms. We're going to look at the expiration dates. We're going to look at the renewal history of contract by contract. We're going to look at where they upsell, where they downsell, to get to a net retention number. And then ultimately look at the margins across those contracts. But every SaaS deal is going to have a big spreadsheet that's got every single customer. We want to go back 5 years if we can, and look at all of them. And so you're just doing analysis on the revenue pool to really understand it. And then you're looking at growth, and you're looking at their pipeline and trying to figure out what's also going to come on. But if you've got a good business that has really high 90% retention, you know, it's not a leap of faith modeling that out when you really understand it on a customer by customer basis, to get comfortable with the projection, you know, versus some companies that you're looking at and you're like, man, you know, I don't know where this is going. Let's be optimistic with it and put a 10 or 15% growth rate on it. On this, you really feel like you come out of the diligence saying, I know within a small bandwidth where this revenue is going to be.
And you know whether the owner or seller has lowered prices to add more customers or has raised prices. I mean, you can see that variable, and so you can tell whether, and that should trickle down to your margins. So if you got good gross margins or good EBITDA margins, you know, you haven't changed maybe your pricing, or you've sold, and so that spreadsheet's going to just tell the story.
So much visibility in terms of the revenue. So it starts there, and then just to get to earnings, man, when you look at the typical smaller software company, that the P&L is simple. You got the revenue, and then you got your COGS, which are, you know, some dev costs in there and your hosting costs, and then it's basically people. And so then you get deep into the org chart and you figure out where it's at, you figure out what resources you need to grow, and you have a high confidence level in what your cash flow is going to be or not be. You really do. And you have a pretty high confidence level in its scalability.
Right.
Because if you're driving 80% gross margins and most of the rest is people, the big exception being technology expense, really the CapEx side of dev, you really can get a good handle on your cash flow. And it's that simplicity in a way and ability to understand what the numbers are going to be that allow you to be more aggressive on valuation if you like the business, allow you to be more aggressive on growth or generating cash flow, or whichever way you want to go with it.
There was a question back there.
Question two on the revenue retention side. When you're looking at that analysis, let's say you sell your product for seat licenses, right? So you've got maybe, right, Chevron as a customer, you've got 1,000 seat licenses. When you're looking at retention, you're looking at the number of individual seat licenses, or are you kind of looking at like Chevron as a whole and how sticky is Chevron versus Chevron's got 1,000 licenses this year. Last year they had 500. Like seat level or in client level?
Both. Yeah. So we're going to look at customer logo churn. How many customers did they lose? How many customers did they gain? And then to get to the industry vernacular, net retention means you're looking at your upsells. So how many seats did we add at Chevron? So how much did the revenue increase? Or your downsells, did I lose seats? Did I lose revenue at customers? And again, you get all that data on a spreadsheet and you can just geek out with it, and it's awesome.
Geek out, that's an accounting finance term. Yes, Lindsay.
What would you say the max customer concentration for your software for these types of transactions? What is kind of the number where you start saying, I don't know?
So the question was, what is that magic number where customer concentration for a SaaS may be just too large?
So I'll start and then segue to you guys. So for me, if the largest customer is 5% or less, I'm like, this is a real SaaS business. I'm excited. If the largest customer is 10% or more, you're starting to look into it to say, what's going on, and then you're really digging into the rest of the revenue pool to say how diversified is it? Why do I have one customer that's so much bigger than the others? And digging in like you would at any other company.
Eric or Aaron?
Yeah, I mean, really it goes beyond SaaS. Low single digits for customer concentration, and then from a transactional perspective, if you've got high customer concentration, there's probably a lot of unexplored, untapped market to bring that number down, and that just becomes how do you resource that plan is one of your management objectives to kind of get that in better, less, reduce that risk, right? To get that in better shape. So it's actually can be a positive if you buy it right. Like that's actually one of the opportunities. I think in a lot of cases you would expect that to affect multiple You know, so.
What was that top number again? 5% or less is great.
10% or above for largest customer, you're figuring it out. Yeah.
One for more comment on the seat light, you know, if you think about, I don't know how many here use or are familiar with CapIQ, you know, we have spent a lot with CapIQ over the years, and they were a seat license, a user license model forever, and then they warned us, hey, we're going away from that. And so from a business management perspective, why would you do that? Because you're tired of your quarterlies having to worry about upsell and downsell. And so then they go to a utilization model where they're watching and monitoring how all these corporate accounts and what features are they using, and using that differently to be able to upsell, downsell. And it just becomes a price and a value discussion as opposed to a seat license discussion. So CapIQ's having to, as we experience it, I don't know if this is their intention, but they're having to sort of reframe their value prop to the market to come off of this really ticky-tack measurable way to think about risk, right? And it becomes more of a discussion about value.
Any other questions? I think we've about run out of time. Any other thoughts? So I guess, you know, the panel basically is suggesting think about it twice before you advise your company to dive into a SaaS-like technology.
Measure twice, cut once.
That's it. There you go. There you go. So I think that's it. Any other questions? Well, thank you very much.
Thank you.
Thanks.